Inflation is a general and continuous increase in the prices of goods and services in an economy over time. Inflation can be measured by the increase in the Consumer Price Index, CPI, which is a weighted average of the prices of a basket of goods and services that ordinary people buy, such as food, fuel, clothing, housing, transportation, and public services. There are several theories about what causes inflation, but one of the main ones is the demand theory. According to this theory, when there is an increase in demand for goods and services in an economy, producers raise their prices to maximize their profits. If supply cannot keep up with demand, prices will continue to rise, leading to inflation. Another theory about inflation is the supply theory. According to this theory, when there is an increase in production costs, such as higher wages, higher taxes, or higher raw material costs, producers raise their prices to maintain their profits. If these cost increases persist, prices will continue to rise, leading to inflation. Inflation can also be caused by external factors, such as an increase in the price of oil or a devaluation of the currency against other currencies. Inflation can have negative effects on the economy, such as reducing people's purchasing power and increasing the cost of borrowing. The government may try to control inflation through various policies, such as raising interest rates to discourage consumption and demand, reducing public spending to reduce demand, and increasing taxes to reduce demand. However, these policies can also have negative effects on the economy, such as slowing economic growth and increasing unemployment. An example of inflation affecting the purchasing power of a product. Suppose that in January 2021, the price of a 1 kilogram package of rice was $5 and a person could buy 20 packages with $100. In January 2022, due to inflation, the price of the 1 kilogram package of rice increased to $6. In this case, with the same $100 that the person had in January 2021, she can only buy 16 packages of rice in January 2022. This means that, due to inflation, the person's purchasing power has decreased, as she can now buy fewer packages of rice with the same amount of money. This can happen in relation to any product, and inflation can significantly affect people's purchasing power and their standard of living. How does the government lose control over inflation? The government can lose control over inflation in several ways, some of which include external shocks. The government may lose control over inflation if unexpected external shocks occur, such as an increase in the price of oil or a global financial crisis. These events can affect the prices of products and services in the economy and make it harder for the government to control inflation. Ineffective economic policies. If the economic policies adopted by the government to control inflation are ineffective, inflation may persist. For example, if the country's central bank raises interest rates too slowly or too quickly, this can lead to undesirable outcomes and a loss of control over inflation. Failures in policy implementation. The government can also lose control over inflation if there are failures in policy implementation. For example, if the authorities responsible for policy implementation are corrupt or inefficient, this can lead to problems and failures in policy implementation, which can lead to a loss of control over inflation. Structural factors. In some cases, inflation may be caused by structural factors, such as the lack of competition in certain sectors, the presence of monopolies or oligopolies, or the rigidity of the labor market. These factors can make it harder for the government to control inflation, even with effective economic policies. Inflation is a complex phenomenon and can be influenced by many different factors. That is why the government needs to constantly monitor the economy and adjust its policies to maintain control over inflation. How can people protect themselves from inflation? There are some strategies that people can use to protect themselves from inflation. Some of the main ones are investments in real assets. One way to protect against inflation is to invest in real assets, such as real estate, land, gold, silver, among others. These assets tend to maintain or even increase their real value over time, even during periods of inflation. Investments in inflation-indexed bonds. Another strategy is to invest in inflation-indexed bonds, which are debt securities in which the nominal value of the principal and interest payments are regularly adjusted for inflation. These bonds can provide protection against inflation as the interest payments and principal value increase with inflation. Diversification of investments. It is important to diversify investments across different asset classes and currencies to reduce the risk of losses during inflation. Diversification can help balance the risk and return of investments. Maintenance of reserves in different currencies. Maintaining reserves in different currencies can help protect against inflation. If the local currency loses value due to inflation, reserves in other currencies can help offset losses. Investments in stocks. Investing in stocks can also be a strategy to protect against inflation. Stocks of companies that have the ability to increase their prices and profits during inflation can benefit, and the dividends paid by companies can help protect the investor's purchasing power. It is important to remember that no strategy is foolproof and that risk is always present in investments. The choice of strategies to protect against inflation will depend on the financial situation, objectives, and profile of each person. Therefore, it is always advisable to consult a financial professional before making investment decisions. Some countries have been economically destroyed due to inflation, leaving the population in poverty. Uncontrolled inflation can have devastating effects on a country's economy. Examples of countries that have experienced hyperinflation, which is a very high and uncontrolled inflation rate, include Germany. In the interwar period, 1914 to 1923, Germany experienced hyperinflation that destroyed the country's economy. Prices increased so quickly that people had to carry wheelbarrows full of money to go shopping. The German government printed an excessive amount of money to finance World War I and pay reparations, which led to hyperinflation. Zimbabwe. In the late 2000s, Zimbabwe experienced hyperinflation that reached a rate of 231 million% per year. Inflation was caused by a series of factors, including inadequate economic policies, illegal land appropriation, and excessive money printing to finance government spending. Venezuela. Since the mid-2010s, Venezuela has been facing hyperinflation that has made the country's currency almost worthless. Inflation was caused by a series of factors, including inadequate economic policies, falling oil prices, the country's main source of income, and a lack of confidence from international investors. Argentina has a long history of economic instability, including periods of hyperinflation. The most recent was in 1989 when inflation reached a monthly rate of over 3,000%. Inflation was caused by inadequate economic policies, including excessive government spending and excessive money printing. These are just some examples of countries that have faced hyperinflation at different times in history. Uncontrolled inflation can lead to a fall in the value of the currency, loss of purchasing power, unemployment, increased poverty, and inequality, among other economic and social problems. That was today's video on how inflation works. Watch this other video about the world's richest families. Don't forget to leave a like and subscribe to the channel.